Canadians are seeing one of the biggest interest rate hikes we've seen in over 20 years. And with that, a lot of people are asking the question, what type of mortgage should I be getting, variable or fixed? So let's talk about that right now. The Bank of Canada just announced that they'll be raising interest rates, and this causes a lot of anxiety amongst home buyers because they're wondering, what is this going to mean to their mortgages? So let's take these percentages and put them into dollar value just to give us a little bit better perspective. In my previous video, I talked about rising interest rates and also discussed how every 0.25% increase will affect you as a home buyer if you're buying a $1 million home. So we're going to use that same example just to contextualize things a little bit. So let's say you're buying a $1 million home and you're putting 20% down, which means you're putting $200,000 in, and you're getting an 80% mortgage, which is $800,000. Simple numbers, easy math. Now, if you do a quick Google search for mortgages and you just look at what RBC is offering, they are offering a 2.2% variable mortgage as well as a 3.9% fixed mortgage for 5 years. Now that's a 1.7% difference, but on an $800,000 mortgage, what does that actually mean? Well, I'll tell you. See, a 2.2% variable mortgage is going to cost you $3,469 a month. And if you do your 3.9% 5-year fixed, we're looking at $4,179 a month. Am I willing to pay $710 more on my mortgage for the fixed, which essentially gives you certainty, or should I be going for variable? Now, the question everybody asks here is, will interest rates increase such that I will be paying more on my variable mortgage than I would have otherwise be if I was paying fixed? For $710, you gotta really be thinking about this to make the right decision for you. Now, there are obviously a few more things that you wanna be considering. Like if you're a real estate investor, you wanna make sure that the variable rate goes along with your strategy unless you have very fixed bills that you're going to be going along with. If you have a family to consider, maybe the stability is something that will help you sleep at night. Because a lot of the times, what people don't always consider is that when they're trying to make a decision as to which one is better for them, variable or fixed, they don't consider the emotional aspect of it. The best way to go about picking your mortgage isn't entirely done by mortgage speculation, but it is instead better done by determining your own risk tolerance. And that is something that you have to do carefully, and you have to weigh in a lot of factors that somebody else can't necessarily do right for you. Now, the strategy that I go with is I always go for variable. And the reason for this is because historically, variable has always outperformed fixed mortgages. And the reason why is because they are designed to do so. No matter what it is that the banks are doing, they're going to be making calculated risks, right? And because of this, they are essentially charging you a premium for giving you stability. And essentially, if you're saying that for 5 years, I want to be committed to a fixed price, and this is what we're going to do no matter what happens, interest rates can go up, they can go down, but whatever it is, I'm paying this. The banks are essentially factoring in a premium to cover the risk of them giving you a 5-year fix in case the interest rates do actually go up, and then they're going to be finding themselves in a position where they're losing on that money. But that $710 difference, if you wanted to go for fixed, you're essentially suggesting that variable will increase by 1.7% from where it is right now. But it's not even just as simple as that. A lot of people look at it as a singular dot. Like if in this month, variable rates go up higher than fixed rates, I'm going to be upset because I'm now losing money. But you really have to take into consideration the bigger picture. So let's give you a good example here. We already said that $710 is the difference every month between a 5-year fix versus a variable. That means that if I select a variable mortgage right now, I'm paying $710 less. What I would do is I will take that $710 and I will bank that money and treat that almost like forced savings. If interest rates go up, what I would do is I would dip into those savings and I will use that to pay for the increase in the mortgage rate. If it doesn't go as high, basically I've now put money into a fund that because it didn't go up high enough, that money is now mine. If it did go up, let's say over a period of 5 years, let's say it took 2 years to go up to what is currently the fixed rate. I have 2 years now of saving $710 a month. And even if it goes higher after that, I can still balance out. So that is one strategy that you can use. But again, you have to make sure to calculate this in your margins. If your margins on a purchase only account for the cheaper 2.2% interest rate mortgage, the variable mortgage, you are riding a thin line, and you really need to be careful with how you're approaching this because your margins don't allow for any fluctuations. You have to make sure that you can afford fluctuations in the market if you're going the variable rate. Chances are it will still outperform the fixed rate, but you need to, again, make sure that you are not thinking every month of how am I gonna pay these bills. So whatever it is that you do, just make sure you budget for it, but that is what I'm doing. I'm going for the variable rate because I believe that I can weather the storm, so you need to decide whether you can do so as well. So there you have it, guys. Now I wanna know, what type of mortgages would you pick? I would pick variable, but I know a lot of other people have different opinions on the matter. I'd love to hear about them. In the meantime, make sure to like this video, subscribe to our channel, and check us out for weekly videos on the real estate market.